Welcome to On the Bricks. We're here for the third class in the Breakfast and Business session. Today we're going to be taught by Lisa Phillips from Bank of the Panhandle, and we welcome you all.
Thank you. Good morning, everybody. Thanks for joining us again. Glad to have such a good turnout. And of course, I can talk about business and cash flows all day, so I'm excited to get to do that with you. Today's session is Am I Making Money? And just a recap of things we have covered and are going to cover in this series. We have covered, so you want to own a business, and we've covered capital and cash flow. Today we're going to talk about Am I Making Money? Next week, Make Banking Work for You. We'll talk about all the different banking products that you can utilize for your business. October 4th, Small Business Roundtable. The 11th is Human Resources, 18th Retirement and Succession Planning, and finally the 15th Insurance. So lots of good stuff coming up. So today, am I making money? We've talked about this before. Yes, they are making money. And it almost sounds like a trick question we were talking about before class. Am I making money? Like, I thought I was making money. Am I making money? So we're going to go through not only are you making money, but how to interpret financial statements and some basic ratios for you to run to determine am I making money and how might I compare to my competitors. So am I making money sounds like a pretty simple concept. It's just money in and money out. Are you bringing in more income than what you're spending in expenses? So if you just came for breakfast and you want to ditch class now, this is really all you would need to know. You just track the money that you're receiving, you add up all your expenses, and then you subtract expenses from income. Pretty simple calculation. And I'm surprised at the number of people who don't know if they're making money or not. So we're going to go through a financial statement and maybe think about some things you might not have considered before. So today we're going to talk about parts of a financial statement. We're going to talk about financial statements quality and their basis of preparation. We're going to talk about some financial statement terminology. So when you sit down with your banker or advisor, you'll be able to speak a little bit of the language they might use. We'll talk about profit margins, EBITDA, and lots of other fun stuff. Then we'll get to the meat and potatoes of it. Am I making money? We'll talk about some different concepts, income versus profit, break-even analysis, bottom lines. And then finally, we'll talk about reasons why you're not. It might be unfair to go through the whole hour and talk about are we making money and then not consider some of those things that might be causing us not to make money. Okay, so parts of a financial statement is where we'll start. And in your packet, there is an example company, XYZ company. So parts of a financial statement, here when we say financial statement, I think people are a little unclear. Do you mean balance sheet or do you mean P&L? What do you mean by financial statement? And so I say financial statement is a packet of information. A financial statement should include these things. It should include a balance sheet. It should include an income statement, some kind of statement of retained earnings. We'll talk about all these pieces in a little bit. Statement of cash flow, footnotes, and an opinion letter. If a CPA has prepared a financial statement for you, it will be covered with an opinion letter saying, I have done this and this is what I found and it's good to go. Here is your financial statement. Okay, so let's flip through this. The first page is your balance sheet. And a balance sheet is a list of things you own and a list of things you owe. And whatever's left over is the value of ownership. So assets at the top there, everything you own. And it's split into current and non-current or long-term. And current would be assets you think you're going to turn over in less than a year. and long-term would be things you're going to hold on to for longer than a year. So you can see current is cash, accounts receivable, inventory, kind of temporary things. You may always have cash, or you hope you do, and you may always have inventory, but those things are going to cycle through. Whereas your equipment is going to be more permanent. Your building is going to be more permanent. Then we have liabilities. And so this is everything you owe. And the same concept, current would be things that you're going to pay off in less than a year. And then long term is things you're going to have for longer than a year. And those usually match. Your current liabilities will match to your current assets, and your long-term debt will match to your long-term assets. And then finally at the bottom, shareholders' equity, which is the value of your ownership. So if you take everything you own, subtract what you owe, then you have some worth or equity in all of your property, and that would be your value of ownership. So you can see retained earnings on this statement, $17,166. Any questions about a balance sheet? I'll note that at the top it says June 30th, 2002. A balance sheet is dated the last day of the period. So you can stop at any point and pull a balance sheet. And a balance sheet is a accumulation of everything that's occurred in your business to date. So from inception to now, this is everything that has gone on with your business. Typically, we see these statements come at quarter end or at month end or at year end, not the 24th of the month. It's kind of odd to stop your month in the middle, but you can. Any questions about a balance sheet? So the next page is the income statement or profit and loss statement. And this is not cumulative. This is just for the period that's happening. So this might be just for the month, just for the quarter, or just for the year. And you can see at the top it says it's for the year ended June 30th. So their year end is June 30th, so you could assume that this is for a 12-month period. And most will have a comparison of last year to how this year looks. Revenue is typically broke down into additional categories, but for this illustration, it's just totaled, summarized. Then cost of goods sold is items you're going to be selling. If you're a retailer, this is items you're going to hold for resale. So literally the cost of things you're going to sell. And so revenue minus cost of sales equals your gross profit. Then we have operating expenses, and it says schedule there, and we'll look here in a little bit at the schedule of expenses. So gross profit minus these expenses equals your income from operations, $77,855. And then we have some other income and expenses, and other is typically not associated with your business, with your production. They're kind of side things. My example always is like a hotel will have hotel income and hotel expenses, and then they'll report in other income vending income because they have a vending machine that sits in a laundry room, and it's very small income, very small expenses. So they'll kick that down to other. That way when they're looking at the bulk of this financial statement, they're looking at hotel operations. Then they can look down at the bottom and see on the side we had vending income. You can see on this one they had sold some property and they took a gain on an sale of an investment, and those are kind of one-time expenses. Once you sell an asset or sell an investment, you're not going to have it again and again. So that's probably why they kick that into other. So subtracting those out, then you get net income before taxes, $92,903. And then of course, income taxes need to be taken out. So then we have a net income of $78,516. Now that's where the income statement kind of ends, right there at net income. And then we have deficit beginning of the year, dividends, retained earnings. That would be our statement of retained earnings, our item number 3 up here. And in this illustration, those two statements are combined. But this is a cumulative of your earnings. So this is keeping track from inception of your business to today, how much have you had in earnings. So you can see in the year 2001, they started out with a deficit. So from inception to the end of 2001, they had lost $54,000 life to date. And then they took $16,000 in dividends, which worsened the situation. So they started then 2002, $61,000 in the hole. And they added in that $78,000 in earnings. So their retained earnings year to date or life to date is $17,166. So they started out 2001 in not a very hot position, but they had great earnings in 2002. So that enabled them to report net earnings of $17,000. So they're actually building some health back in their business. Any questions on that?
No, it said 16,000 of that was a one-time sale, so.
Yes, sure. So up there in other income, you can see we sold gain on sale of investment of $16,000. So when you're looking through here, you have to consider what are normal, healthy uses and sources of cash, and then what are not so healthy sources and uses of cash. And if you had to sell an asset or you had to sell an investment in order to report a profit, that might indicate that you're in some kind of stress. Clear as mud. We look at these all day long, so I'm kind of a numbers nerd. Any questions on that? Okay, so then the next page is statement of cash flow. And I know that's kind of confusing because last week we talked about cash flows and this does not look like what we talked about. But this statement is truly the sources and uses of cash throughout the year. And instead of being broke down by period or by month, this is just for the whole year. So it will talk about things that you used cash on and where you got cash from, if that makes sense. I don't find that this statement's incredibly helpful for a small business owner, especially a new business owner who's not used to looking at these statements. But as you get comfortable with it, you'll be able to pick up items where, ooh, I had a big source of cash from here, or I had a big use of cash here. As you can see, about halfway down, they had long-term debt, current portion, $25,200. That is them repaying debt. So that's pretty big use of cash. Am I reading that right? And then further down, you can see how much came from financing activities, how much they had to borrow. So again, kind of a confusing statement, but it's part of a financial statement. So if you go to your accountant and get a financial statement, that's going to be included. And then finally, next page is part of the footnotes. There will typically be other illustrations or other comments from the accountant, more detailed schedules. So you can see the first one is that operating expenses. Back on the income statement, it just gave one total, $286,000. But here is the breakdown of all of those expenses. So there's a couple of things I like to do with these expenses. And that is just compare year over year. What expenses went up, what expenses went down. And this is a good place to start if you need to trim expenses. This gives you a snapshot of, did I really need to spend all of that in advertising? Was that all necessary? And you have to think of the concept, I have to spend money to make money, and that's very true. But also have to think back to last week, do I have the cash available to spend those things? Can I commit to a $1,500 a month advertising plan when I don't really have $1,500 yet? So this will be different based on your business and your plan, your model. There are a couple of things like supplies. When we started our own business, unbeknownst to me, they ordered a case of toilet paper. I was like, we do not need a case of toilet paper. We need like one pack and we'll be good for the week. And then when we get some more income, we'll buy some more toilet paper. But no, they thought a case of toilet paper was just... So little things like that. Travel, it's really easy to put your travel expenses into business called maybe research and development. If you have to go to Las Vegas and see what's the latest on the market, that could be useful. It could be a trade show that you need to go make purchases at, but it could also be you goofing and disguising it as travel expenses. And just consider what that might do to your business and how healthy your business looks on paper. And then vehicle expense would be another. If you're looking for places to trim, just think about how can I save money? I didn't realize my vehicle expense was that high every year. I knew that every month it cost about this, but that's a big number. Also, something that you can do with this is called common sizing, which I think is in our next slide, is taking this expense line item, so advertising, 18,801, and dividing it by total revenue. And that'll give you a percent. And so that says, how much of my income am I spending on advertising? Because you can look at that number and say, advertising went down considerably from year to year. But as a percent of sales that I'm bringing in, what did it look like? And then you might feel better about your advertising dollars, that I spent less on advertising, but I got more sales. And you can do that every single line item. I think that is it for financial statement. Does anybody have any questions on that? I don't have a sample opinion letter to show you, but we'll talk about that in a minute. Okay, so there are different qualities of financial statements. First on the list is unaudited. So it's just something you prepared out of your own accounting software, and no accountant and no CPA has looked at it. It is self-prepared or internally prepared, which is fine. And then this second is a compilation. So you have taken your financial data and given it to an accountant, and he has compiled that information. And he has done just that. He's compiled what you have given him. So the numbers that he spits out are only as good as what he's putting in. He makes no certification that these numbers are correct. He makes no certification that your internal accounting policies are correct. He's literally compiling the numbers for you and then spitting out a financial statement. Number 3 is a review. It's also prepared by a CPA, and it will cost you a little more money. It is certified in some aspects. The accountant has reviewed your internal controls, but he will not go through your entire set of books to make sure everything is correct. And it too will cost you a little more. The most expensive on the list is the audit, and it is a full-blown audit. The CPA will review all of your books. He may even send letters to your vendors saying, she says she owes you $20,000, is that true? Or you owe her $15,000, is that true? They may even go through and count your inventory and be sure, hey, you said you had 200 widgets in stock, let's go count those and be sure. They will be sure that your internal controls are working properly. And again, it's very expensive. So you might say, well, why does this all matter? I like to use my whiny voice, but why? Why do we have to do this? Why do I have to spend money? There's a couple of reasons. Is that these financial statements you're usually giving to a decision maker, to a banker, to an investor. Obviously, you're making decisions about your business based on these financial statements. So you may want to spend some money to make sure that they are good quality. Also, this business may be something that you are building to sell in a few years. Just like the school teacher we talked about last year who sold her business for $66 million. It could happen. I'm still holding out for it. I don't have an idea yet, but it could happen. So having a history of good quality financial statements are really important in those cases. If the seller comes to you and says, how's this business been doing? And you throw out like a legal pad of your books, they might be a little concerned about the accuracy of the bottom line. Where if it's a review or audit, they know that not only have you committed the money and time to doing it, but that these records are accurate. Any questions about all that?
So with an audit, do like insurance companies want sometimes to request an audit of what's going on with your business, or is it just pretty much just for financial with the bank?
This would be for financial reporting. It's the CPA. You're telling the CPA I have 200,000 in inventory, he's going to come in and verify it.
Okay.
And there's different degrees of that. He could literally be counting it, or he could be going out to the market and seeing that you have it valued correctly on your books. If you needed just an inventory audit, I'm sure a CPA could prepare that for an insurance company as well. The audit will be a full-blown torture test if you
Sounds
so choose. And sometimes with big businesses, it's worth the expense. We finance some title companies, and for their licensing with the state, they're required to get, I believe, review compilations on each one of their plants. So it's an expensive process, but
it is what it is.
it's part of it.
How common is it for small businesses to do an audit, have an audit done?
It is not. I think we only have one or two borrowers, the title company being one that has an audit. I have seen co-ops have audits. They have a lot of grain moving, and the quality of grain is important. So the auditor will go out and actually pull cores from bins and make sure the quality of grain is what they say it is, and they will weigh it. They will check current market prices to be sure it's valued correctly. There's fuel involved. So you can tell by the complexity of that business that it might require a little more in-depth financial statement. Small businesses, we will typically get unaudited financial statements from Quicken or QuickBooks. QuickBooks probably most often. I've seen legal pad accounting before, probably once a year. If it works, it works. You know, you think of like in the movies, the lady like pulls out the giant book and it's spread all over her desk, and she knows exactly this pile's this and this pile's this, and if you mess up her pile, the business will like crumble, but she knows what's going on. So unaudited are certainly not bad. Compilation's the most common we see. I would hate to guess how much a compilation would cost you. Most people will retain an accountant for a monthly fee. And I would say depends on how involved your business is, $200 a month to $1,000 a month and on up. That's something in our business that we kind of negotiated with the accountant, is that we want you to do these things per month and provide us quarterly financial statements. What do you think that will cost us a month? And that helped me know that I could count on that cost and not get any surprise bills for some extra counting that they did.
Yeah.
Oh, also I was going to add that contracts might require it. So if you are working for the government based on any contracts, the government may require that you have a certain quality of financial statement. So that might be another reason why you would invest in a compilation.
A lot of times you can get grants also.
Yes.
Oh, yeah.
Good point. Okay, let's see if I'm caught up with myself now. Okay, so when you're looking at a financial statement, there's some questions that you need to ask, and I think most people who are not in accounting would not think to ask this, but that is, what's the basis of this financial statement? Is this financial statement prepared on a cash basis or an accrual basis? And it can trick you if you don't know what accounting method they're using. So we're going to talk about cash versus accrual. Cash basis of accounting is just that. It's the revenue is reported when you receive the cash in your hand, and expenses are reported when you actually spend that money. And so it's like the checkbook method of accounting, like the cash flow we spoke of, is when that income comes to you, you record it. When that expense goes out, you record it on that date. Accrual basis, the revenue is reported when you earn that money. So in our example last week of the t-shirt business, you made all these t-shirts and then you sent the bill. It might be a while before you get that money. But in accrual basis, you're reporting that income when you send the bill, not when you receive payment on it. And then expenses are reported when they're consumed. So you might have bought a bunch of office supplies, but you're not actually going to report that expense until you're using it. Puzzling?
Can that method of accrual be risky? Because if you're waiting on a pending payment for 1 month and you reported it for your monthly statement, and these people just happen to be late, now your next month shows up, and you don't have the actual generated profit for that month.
Right.
So your books are actually off, and then you come into the next month and all of a sudden it shows up as a surplus, or maybe it doesn't, and it has to go to collections, and now you have to pay part of the collections, so now you don't actually have what you had.
Yes.
So you don't
Vicious
have
cycle.
an accurate running of it, as opposed to the checkbook method, which sounds simple, but at least
Right.
it's cash in hand and cash out of hand every time.
Yeah, we see cash method most often from small businesses just because it gives you a clearer picture of what's happening with your cash. Whereas accrual basis, you can get kind of lost in those details of, I don't have this money yet, but I have the expense, and so it's not matched up. Accrual method's required, I think, for businesses who have 5 million in sales or more for your tax return. So it's a good chance if you have a big business, you're going to get to do some accrual accounting. But also your accountant can prepare both types of statements. I'm not familiar with QuickBooks if it can spit out two different types of statements. But when you're looking at the financial statement, if you happen to just get your own business from your accountant, be sure that that's the first thing you're asking. Is this cash basis or is this accrual basis? Because in accrual basis scenario, there might be income on there you haven't received yet. And your checkbook is probably telling you there's a good chance that what I have in cash is not matching up with what my income statement says is happening.
Yeah, then you end up overdrawn on your account.
Yes, yes. As I said, it's always easier, I think, to keep a business account and a personal account. Keep those two separate, so that will indicate kind of where you're at cash position. And then also getting these financial statements and keeping them separate, but keeping your own set of running books. And you might have your accountant do something else, but to at least keep in your own mind what you think is going on, so that when you get this financial statement from the accountant, you can know maybe where he might be off. Okay, any other questions about cash versus accrual? I think where this comes in, becomes a little painful, is that when you have done a project in 1 year, and then all of a sudden you've crossed over into the new year and you start getting paid for that job, it's hard to see if you made money on that job. And so then you need to adjust back and match up that job's expenses with that job's income, regardless of what year, what month they are reported in. And again, that's why I think having your own software is important, so that you know that when all of this income and expense gets scattered, that you can match up that job made a profit or that job did not make a profit.
Because if you don't, especially at the turn of the year like that, wouldn't you be technically claiming a profit on your taxes that hasn't shown up yet?
Yes. And then maybe reporting a loss the next year if you get... Usually those expenses come first, and so you get to report that loss, and then later the income comes in and you get to pay taxes on that.
So what would you do, like, for example, if we have a job for $50,000 and we get paid the $50,000 in December? Well, we get all the materials for the job in December, and it's $50,000 of material, and we're going to be making $100,000 in the next year. What do we do for, like, tax-wise, since we bought our supplies in December, but we're finishing and getting paid in January or February?
Well, it'll depend on which method you're using for your tax return, and your accountant can help you decide which method you're using, and also doing some tax planning.
Okay.
So going to see that accountant in October or earlier and saying, if we get this job, there's a good chance we're going to cross over the year end and not have it closed yet. What are we going to do for tax planning?
Okay. Thank you.
Yeah. So again, but why? I think we covered but why. You just want to ask yourself if this is this cash basis or is this accrual basis. Okay, next is some financial statement terminology. Analysts and bankers like to talk in these terms a lot, so I just wanted to cover, if someone asks you what's your gross profit margin, that you can respond with confidence and that you know how to calculate that. So gross profit, if you flip back to your XYZ company's income statement, you can see that gross profit is the line item there, and it is simply revenue minus cost of goods sold. So it's how much I had in sales and how much those sales cost me in terms of materials or labor, direct expenses. And then gross profit margin would be that gross profit, so 364,000 divided by my revenue, the 1.1 million, will give you your gross profit margin. And then net profit, again, it's a line item down there toward the bottom, and it's revenue minus cost of goods sold minus all your other expenses gives you a net profit, kind of a bottom line. And then your net profit margin is that net profit. So in this case, the net income of, we'll use 78,000 divided by your revenue of 1.1 million. And then EBITDA. I think bankers mainly will talk about this, but accountants might also. It's simply earnings before income, taxes, depreciation, and amortization. And then common size we talked about earlier. It's taking the line item, so advertising expense, and dividing it by your total revenue, that 1.1 million, and it will give you a percent. And so you can see as a percent of revenue how much is travel costing me or how much is advertising costing me. And that's good for year over year. When you have years to start comparing, you can say last year I only spent 15% of my revenue, my income on advertising, and this year I'm up to 18. Is that necessary? But also good when you start doing some research about your industry and knowing, is that normal for my industry to spend that much? You may not know. There may not be significant data. So as we talked about before, most people I think have a hunch on whether they are making money or not. They just look at their checkbook and decide it's in good shape or it's not in good shape, so I must be making money. But there are people we encounter who really don't know if they're making money, or they think they are making money, and we dig through the financials and say, you are making money, but your trends are going downhill. There might be some things you want to correct before it becomes a problem. So we're going to talk about some concepts beyond just income minus expenses to think about. The first one is income versus profit. And from our review of the financial statement, these are not the same thing. People are really good at recording their income. They get that check and they run it to the bank and they put it in their register like, yes, I have income. I made $5,000. It's kind of like the casino, the gambling method of math. Like, I won $500. Well, how much did you spend? I spent $600. I think that means you lost $100. So people are good at recording that income, but you have to remember that's not profit. You got to take out your expenses. And so profit really is your bottom line after all of your expenses. The next one is calculating cost. Now there's two types of cost, fixed cost and variable cost. And we'll talk about them in depth in a minute. But when you're sitting down to do your projections or your analysis, you should have a good idea that if I need to make 100 widgets, it's going to cost me $10 in supplies. So $10 in supplies or 100 widgets. If I'm going to make 200, then it's going to cost me $20. Just to have an idea of what your costs are going in so that you know if things are looking normal, if they're not looking normal. And it also helps you figure out a budget or a projection. Okay, so fixed cost would be all those costs that are going to be the same every month. You know that rent is going to be the same every month. You know that your rent contract is up next April, and so the rent might increase then. For the most part, some labor will be fixed. Your accountant is going to charge you a flat rate every month. So you'll be able to plug in these numbers as you go. Variable costs, on the other hand, are associated with your production level. So the more widgets you make, the higher your cost is going to be for nuts and bolts. Possibly your utilities will go up. It's tied to your production. And some expenses are both. I think of it as in utilities, you know you're going to pay at least $150 to the city, but the more widgets I'm producing, the more that's going to come up. So some expenses you're going to want to create 2 line items, one a fixed portion and one a variable portion. And the same with labor. You're going to have office staff that's going to stay the same, and you're not going to pay them anymore based on widgets. There's going to be the person in the back assembling widgets who's going to get overtime based on the number of widgets you're making. So part of that labor expense is going to be variable. Then we have a little example about break-even analysis. So when you have in mind what your income is and what your costs are, you should arrive at a break-even point. So I need to produce this many widgets in order to break even. Let me see if I can get there easily. Okay, so in our example here, we're going to sell, and this is also in your handout. I think it's just a good exercise to sit down and do. Obviously this one is very simplified, but you can add in here in variable and fixed cost all of your cost. So in this example, we're going to sell 100 widgets. That's my goal. And I'm going to sell them for $25 a widget. And those widgets, they cost me about $20 a widget to make. So in this calculation, my income, if I do sell 100 widgets at $25 a piece, $2,500 in income, I know that my variable cost, this $20 a widget, will be $2,000, so just 100 times 20. And then my fixed cost, I know, is going to be $500 a month. Let's say that's rent. So my profit is 0. So if all it comes true with what I have assumed, I'm going to make no money, I'm going to break even. And then this is just changing the scenario a little bit. I'm only going to sell 80 widgets. I'm going to sell them still for $25 a piece. They're going to cost me $20 to produce. So my income's only going to be $2,000. My variable costs have come down a little because I didn't make as many widgets. And my fixed cost has come down a little. I negotiated a lower rent, so it's only $400, so I'm at break even. And then this is just the same scenario, changing some of the factors, 50 widgets, but I found a way to build them cheaper. I only have to pay $15 a widget to make them. So that brings my variable cost down and I'm at break even. So no matter what you're selling or what your business is, I think it's important to make this list and understand which costs are fixed. I cannot get away from having to pay these. And if I'm paying these, then how many widgets do I need to sell to cover that expense? And then, of course, that floating factor is my variable cost. The more widgets I produce, the more that variable cost is going to go up. And this is just a simple Excel spreadsheet where you can all day change all these different factors and find out if I only sold 40, then I'm going to lose money. So that's in this case. I've set up the formula so that you can change the numbers. Do you have a question? Yes.
Can a variable be considered as a fix? So something like a telephone bill or electric bill that's sort of within the range each month. I know kind of what it's going to be, but it still moves, but can it be?
Yeah, I do that for my own. I know within a few dollars what the utility should be, and I know based on a 3-year average.
So would you put that in your fixed, or would that still be variable?
Really, where you categorize it doesn't matter, and there might be a part of it that you know is fixed, and there might be another part of it that you know is variable. So it's okay to consider it both. So again, this is just a simple Excel spreadsheet. It in its simplest terms is, I think, easy to understand. I realize no one's business is only 4 line items long, so it gets a lot more complicated when you're talking about the number of Snicker bars you're selling or the number of products you have to stock. But really understanding your numbers and owning your numbers is really important. I think in Sally's introduction, the first class, when she interviewed some business owners that work here, one of the main points was understand your margins. You got to know your margins. You got to own those margins. And in my mind, that's not just net profit margin or gross profit margin. That is down to the detail of if I'm making wagons, I know how many wheels a wagon requires and how many axles it requires and what the cost is. And then I also know that I don't have a contract to buy wheels, tires for a certain amount, so that could go up. I need some cushion in case my supplier decides to hike the prices. So you can build out scenarios all day. So we talked about break-even analysis, and then money in your pocket would be any extra. So if you were able to sell, in our example, 150 widgets, then everything beyond, our break-even was 100 widgets, so if you're selling 150, everything extra is profit in your pocket. So we will move on to 3 more ratios I have for you that you might hear someone talk about, and I think they're good to do for your own business. The first one is return on sales. So it's a calculation of how efficient are your operations and how much profit did you produce per dollar of sales. So it's thinking big picture of all the sales I made this year, how many of those sales did I actually get to keep? And the calculation is pre-tax net income divided by sales. So in our example here of XYZ company, our pre-tax net income was $92,000 divided by our $1.1 million in sales is 8.4%. So you made 8.4% on each dollar of sales. It's healthy, it's positive, it's not 50%. And then this will also help you if you can build some years of history to know if you're going in the right direction. Next one is return on assets. And this tells you how well are you using the assets that you have to generate profits. So you have purchased assets, you have purchased inventory, you've purchased buildings even, and so are you making those assets work for you? Were they worth buying? And also when you get this ROA number of yours, you can compare to other companies in your local market and in your industry. There are various resources to find out what is a benchmark for your industry. So it's good to compare these things against people who are doing the same thing you're trying to do. This calculation is pre-tax net income again, divided by total assets. So in our example, 92,000 divided by 276,000 is 33.6%. So you made 33.6% on each dollar of assets you were holding on your balance sheet. Any questions there? And the last one is return on equity. So how successful were you in earning money for your owners or investors? And owners and investors might just be you. And that calculation is pre-tax net income divided by equity. So in our example, if you'll flip to the balance sheet, that first page, we had pre-tax net income of $92,000 again, divided by 17,000 in equity was 541% return. So I would say that is a pretty good return. You had 17,000 in value for your business, and with that you made a profit of $92,000. So that's a pretty good return. Compare that to the prior year where you only made $8,000 and you had 61,000 negative equity, then you had a negative return on equity. So you really had no equity in your business, right? You started the year with 61,000 negative cumulative earnings, and with that you produced a profit of $8,810. It's negative, but it's a return. You made money. Your pre-tax net income is still positive. So I would say that's a great trend from last year being a negative number to 541% return. We've gone through all the numbers, and so you can see from ratios and just looking at the financial statement where you might be making money and where you also might not be making money, where the problem areas are, what expenses you might need to trim in order to make the business more profitable. But the next section we need a little pause for because it's things you might not be doing. And it's more in the philosophy of managing your business. It's not a numbers management. I found an article which I've printed and included in your packets, and it's 8 reasons why you may not be making money. And she footnotes, and some of these might make you mad. So I'll let you read that article later, but she talks about reasons why your business might not be as successful as you had hoped or thought it would be. One, you spend more time talking about your business than doing work on your business. That might be a hard reality check for some managers. You refuse to give up your current lifestyle to make time for your business venture. We don't see that often, but we do see that you like to travel, or you like to spend, or you like to go home and catch up on your DVR at night, and when that time maybe should have been committed to starting up your business. You're waiting for your Prince Charming to come along. Can't believe she went there, but she did. You only do the bare minimum when it comes to marketing. And I think marketing, you've got to consider all your free sources, but also somebody outside of your business telling you maybe what you might be doing right or wrong in marketing. Opinions might be hard to hear, but I think they're also good to seek out. Number 5, you're attached to your own financial sufferings. You know that there's probably going to be some money out of your pocket, and that might be painful for a little bit. 6, you refuse to invest any money in your business. I think we have talked about in class that that's going to be really hard to get by if you refuse to invest any of your own money. You might not like where it heads. Number 7, you don't spend your time on income-generating activities. And number 8, you're attracting scarcity into your business through your own behaviors. I've been reading a book, Tools of Titans, and it's habits of really successful people, what they do on a daily basis, their routines, what they eat, and it's about health and wealth and managing your life. And it says in the beginning, you can skip around in this book. If you don't want to hear the health stuff, you can skip to the fitness stuff, and you can jump back and forth. And when you come to an article, if you decide it's not for you, just skip on. But if you're reading that article and it becomes a little uncomfortable, a little painful, maybe there's a reason that it's making you squirm a little bit, and maybe you need to pay more attention to that. So I'd say if you encounter things that are a tad uncomfortable, consider maybe I do need to work on this, and don't take it as an offense. Later when I ask you for feedback on these sessions, I know some of that might be painful, but how are we going to get better if we don't ask for that feedback? Any questions on that? So here's my own version, the sinkers and swimmers as I call it, written by me, on what will make or break your business. And this is based on our experience with lots of businesses. I've been doing this 16 years, and we have seen everything from startup machine shops to multi-million-dollar motels and everything in between. And there are some definite trends on who are good managers and who are not good managers. So my first one is count your bananas. And that really just means to know your margins that we've talked about. And I say count your bananas because we have some hotel managers that are excellent managers, and they literally know, based on their reservations, how many bananas they need to stock for breakfast the next day. And they know at the end of the day how many bananas are missing and whether that was right or that wasn't right. And they know this about how much time their washers and dryers run, how many trash bags they go through. I would not have thought to ask this, but this is part of their management style. And I think also not only are you counting your bananas, but you're knowing your customers well enough to know, do I stock bananas or do I stock apples? And that you're taking the time to know your customers and know your business that well. So know your margins, I think, is number 1. Number 2, hide money from yourself. Whenever times are good, stash that money away. All of our good managers have reserve accounts, and it's money they just carve out. And if that's $100 a week, whatever they're doing, they are putting that money aside. The account is literally named reserve account, and that's where the money goes to hide. If it helps, don't get a checkbook for that. Don't get a debit card for that. Literally just hide it from yourself and put it away, because I think at some point you'll thank yourselves. When the hotel industry slows, you have no room bookings, you can dip into that reserve and business as usual. The third one is get smart friends, which really just means build a great team. There's going to be lots of things you don't know along this process, and it doesn't hurt to ask someone. And even if you start up a conversation with a friend and they say, oh, I know someone who is really good at this, you should go see them about this. So any place you feel like you don't know or you have a weakness, build that circle. Make sure you have a good team behind you advising you along the way. The third is avoid killer toys. We do lots of ag webinars to just see where the ag market is headed. And a famous speaker in this series is Dr. David Cole, and he loves killer toys. Well, he doesn't love them, but he loves to talk about them. Farmers in particular will have excellent years, and so they will go buy a pontoon boat, and they will go buy a brand new combine, and they will buy that condo suite at the football stadium and season tickets, and then 5 years later they might be regretting not holding on to that money. They should have hid that money from themselves instead of buying a condo. And I'm not saying, some people work to buy that condo or to buy those season tickets, and that is okay. If that's your journey, then do it. But I say always be prepared, and maybe don't waste some of that money. Next one is meals and entertainment. A lot of these big businesses we look at have very small meals and entertainment budgets, and that kind of surprised me. Most people use meals and entertainment as marketing, so you can write it off as an expense, and you're taking doctors out to dinner and wowing them with all of this entertainment, and that's great, but it also consumes up a lot of the cash that you could have been using to buy more inventory to make more sales. So just be conscious of meals and entertainment. It's great. It's great to be able to write off that dinner at Eddie's, but it might not look so hot when you start adding up on your financial statement and be like, I spent $50,000 on meals and entertainment. That's probably a problem. The next one is too many mouths to feed. This is sometimes painful to talk about, but when we see people who are in pretty rough credit shape or condition, a lot of times they have loaned money to family, or they have 12 kids working for them, and sometimes that's too much of a burden on one business. And so you have to be conscious of if there really are too many mouths to feed. Maybe you could have got by with 2 employees, not 6, and you couldn't find it in your heart to cut out 4 of them because you were related to them. And I see this really in my own family, but they needed it. They needed that new dress, or they needed those new heels because they had to go to this dinner. Well, no, they probably didn't. And so getting that clear separation between business and what's good for my business and personal is really important.
A restaurant,
Yes.
they can go broke feeding family.
Yeah.
But you can justify it in your mind, if they came to my house, I'd feed them.
Mm-hmm.
And yet, you have to keep the differences.
Yep. It's hard, and really that's the most, I think the biggest problem in restaurants that I have seen is you spend a lot of money on that steak and you weren't able to sell it to a customer because literally you were feeding too many mouths. But if you think of all that comes in with too many employees, is you've got a lot of, if you have benefits and payroll taxes and wages and the cost of the check and the hours and the accountant, I mean,
Toilet paper.
oh, that toilet paper, the cases and cases of toilet paper. You just don't realize how far it extends. It's true. The next one is long arm of the law, which is just to know the rules and read the fine print. And this in particular is true when you're getting into contracts. We had a customer recently who said he thought all of his competitors were going out of business because they had leased equipment instead of buying it, and then they couldn't get out of the equipment leases. And they realized the equipment leases were way too expensive. They should have just bought equipment. And maybe in that contract it said, you have to stay with us for 3 years, and to get out it will cost you an arm and a leg. And also knowing the rules and regulations that, like in Shelby's case, you need licensing, and if you weren't aware of a licensing that you needed to have, then that can really come and bite you later. Taxes, if you're not tax planning and making sure you're making allotments for taxes you need to pay in the future, that could really come and bite you too. I would really hate to see a business put out of business because they violated something and got caught up in attorney fees that they couldn't afford, when maybe could have been avoidable would they have sought some counsel before they got into that contract. So I say if you're entering a contract, pass that by an attorney, pass that by even your banker, and make sure, am I thinking about everything? Do I have anything? Is there anything you've seen that I need to be sure to include in this? The next one is clone yourself, which would be excellent because then everything would get done exactly like you wanted it. It's not possible yet. So your employees are really extensions of yourself, and they're extensions of your business, and they're representing your business, and it could really sink you if you have one who is not doing a great job, or is not answering questions like you would, or not bidding jobs as well as you would. I always hear the term practice makes perfect, but it's really perfect practice makes perfect. If you're practicing the wrong stuff the whole time, you're not getting any better. You got to practice it perfectly every time. We had an employee who did not know the phone number to our business and had worked there like 2 or 3 years, and I was like, and someone had asked her, I'd like to come see you guys. How do I get a hold of you? And she didn't know the phone number, and I like, oh man, how do you? I can understand how we overlooked that, because you kind of assume that everybody knows your work phone number, but really training those people on how to sell and how to give the answers that you would give, I think goes a long ways. The last one is don't take my word for it, because I'm full of it. And that is to keep your own set of books. Relying on your accountant to tell you if you're making a profit is a scary position, I think. I want to know if I'm making a profit. I want to know if I should make that expense or not. I want to know all of my profit margins, and an accountant to some degree is just compiling that data for you, and may not be advising you unless you're asking for it. And even at that, he's not living in that business. He's not relying on that business for his next paycheck or next meal. He's not intimately involved in that business. So to keep your own set of books, whether that's Excel or Quicken or QuickBooks or any of the like, know where you're going, where you've been. It will serve you well. I think if you're just going to take 2 things away, that would be build a dream team. Like we've talked about before, if you have smart friends and you're surrounding yourself with good advisors, it will serve you well. And know your margins, which we've talked about extensively. I make what-if scenarios all day long here, projections. If sales are this, then what's all the other numbers look like? Or if my costs go up and my sales go down as well, what does that look like? And you can use some simple Excel spreadsheets to help you run all of those scenarios. I like a plan A and a plan B and a plan C, and I'm in risk management for a living, so that makes me a pessimist, I guess. Mm-hmm. But I like to think out all the worst case scenarios so that I'm prepared. And also I like to use that information to make a roadmap or a budget, and make sure that I make adjustments as I go. Just because I set a budget at the beginning of the year doesn't mean that's how things are going to shake out. Or if I make a budget at the beginning of the job and I realize that's not how this is going, it's okay to make adjustments as you go. Okay, I think that's about it. I just wanted to give you some resources on paper. We have talked about a couple of these, but not the others. In starting a small business, I found these websites very, very helpful. The score.org we talked about last week, maybe 2 weeks ago. And it's volunteers, usually retired business people who can help advise you, and it's free. Taxes, I'm always a little hazy on all the tax rules and what I have to pay quarterly and what I don't, and there's some really good courses. I think there was one in Woodward. Oh, I don't know when that's been, but you go for Saturday half day and they talk about all the tax, specifically payroll taxes and how to file those and all that fun stuff. But lots of good resources available.